Joining us is Jeff Currie, Global Head of Commodities Research at Goldman Sachs. Jeff, great to see you as always. Thanks so much for joining us. I guess put today aside, in the short term, clearly we've seen quite a lot of weakness in oil and commodities as a whole. Why was that? Why did we see that weakness?
Well, there was a lot of concerns around the macro backdrop. You had, China concerns, you had Delta variant concerns, and then you had the reflation trade unwind. This caused new shorts to enter the market, which shifted the trend downwards. CTAs ran it sharply. Bottom line, it massively overshot fundamentals, because if you look at the micro fundamentals in this market, they're tight across all of these different markets. They're still in a deficit. Even oil, where you had demand come off, and particularly China because of the Delta variant with lockdowns, you had demand, it came down, but the demand level was still above the supply level, and you're drawing inventory. So now as demand goes up, you have critically low inventories. China re-enters the market. You draw the inventories in the West of both oil and metals. That's what we think is going to be the catalyst to send us back up to 80 in oil and 10,500 in copper. So we have 17% returns expected from now going into year end.
So is that it in terms of the turnaround for oil today with the 5% jump? Is it higher from here until we hit those targets of yours towards 80? Well,
I want to be really careful. The liquidity is very low in these markets. You had equally large down moves as the up move today. That's why I always say when you go through these periods, you can't take the position down because you don't know which day it's going to pop back up. I'm very comfortable once we get past Labor Day and get into September that, hey, these fundamentals are going to prevail and we end up with much tighter markets. The other thing, too, on the physical side, because people were really concerned, particularly given the pullback going in the last week, we had not only liquidation of paper, but we also had liquidation of inventories of both oil and metals, which put further downward pressure on the market. So, now that these fears have subsided, particularly with the news out of China this morning, we think that that's going to take some of that macro headwind out of the market near term. But I want to be a little cautious. Liquidity is very low.
But it kind of made sense, Jeff, that even if you don't think Fed Chair Powell is going to announce a taper this week at Jackson Hole, we know it's coming. The economy has made substantial progress, so they're going to start scaling back stimulus. That's driven up the dollar. That pressures crude. Why do you not think that dynamic will continue?
Well, let's just keep going. Again, commodity markets are driven by levels. Even the tapering is going to mean that, hey, the liquidity is still going to rise, but just not at the same pace that it was before. And if you go back to this, so critical about commodities is that financial markets are driven by growth rates. Commodities are driven by levels of activity. So take oil after the COVID lockdowns in China. The demand growth rate declined. It went down. So financial markets react to that. But supply is down here. So the demand, even though it declined, is still above supply, and you're drawing inventory. So if we take the tapering, the tapering begins, but liquidity is still increasing, putting upward pressure on that demand level, albeit at a slower pace, still is going to keep these markets tight and keep these markets in deficits.
Jeff, I ask you about gold every time you come on. When's it going to rally or fall meaningfully? It just always around this 1800 level.
Well, it was amazing. It kept its ground during this time period, which there was some defensive nature there. Well, the catalyst. I think you have to see people interested in the reflation trade, but the fundamentals. The Chinese arbitrage wide open when you look at the Shanghai premium. That means the Chinese are buying gold. But also when you look at emerging market central banks, in 2018, it was coming from the EMs that were under political pressure, like Turkey and Russia. This time it's broad-based, which means they're diversifying their portfolio. So the fundamentals really look good. You need that catalyst to move you up to our $2,000 target. Which we think will have to be, people getting interested in the reflation trade. What could that be? Oil prices. Oil prices move up to our $80 target or 85 or 90. I think that's going to bring interest back into the reflation trade.